Good morning, everyone, and welcome to our DAT weekly market update. We're spread across 2 continents, 3 countries this morning. Mother Nature hates the DAT weekly update as I'm stuck in Adamo Bunker due to an unforeseen ice storm. We've got Dean Croak fighting off the ruse in Australia, reporting live from down under. And we're very thankful to have Chuck Snow reporting in live from America's Hat. Good morning, gentlemen.
Good morning.
Good morning.
How are you all doing?
We're doing great.
Yeah.
I've often heard Canada referred to as the upstairs neighbor to a really loud house party before, and that's probably a more affectionate way to describe our friends in Canada.
Very well put. I like that.
Yeah. Probably more so in the last 5 to 10 years, but
yeah, I totally agree.
For sure. So, Chuck, do you want to give folks, most people, I assume, watching the show know who you are and your background. Do you mind giving folks a quick rundown on what you've been up to throughout your career?
Well, I entered the trucking business at 21. I had a fascination for trucks, kind of learned how to drive one a little bit, and went out and couldn't get a job, obviously, because I had no experience. And that was back in the days when it was a coveted job. And if you didn't have a father or brother that was working in trucking, especially in a unionized environment, you didn't get a job. So the only thing I could do is I bought a truck with a contract and I learned, I had no experience and went out on one trip to almost the Alberta border and then northern Saskatchewan, which was quite an amazing story because we went out with a flatbed with sides and brought back a load of live cattle on a flatbed, which when people hear about that today, they're just kind of in awe. And the one trip taught me enough so that when I came back the following Monday, I was running New York City by myself. And I did that for a while and dabbled in and out of the trucking industry. And then I decided that I wanted to start a little trucking company, which I did, and did that for about a year, and then saw a real weakness in the industry and saw where trucks were running down from Toronto to the US empty and running back empty. And I thought, I got to kind of fill this void. And hence, that's when I decided I would get into load brokerage, and we formed a company called Traffics, and we really transitioned our trucking fleet into being more of a broker, although we always had some trucks on the background under a different name. And we started, I started with a partner of mine in 1979, and we started a company called Traffics, and we were the first freight broker in Canada to bring the concept out of the basement into the boardroom. And we had an amazing history. I was there from 1979 until 2022 and watched this thing grow from one load and one truck to a business that was doing over $1 billion when we sold. And we sold out to our partners. And I learned all about the brokerage business as I went along and wrote some of the playbook on it for Canada, especially through the years. Because brokerage, even in the U.S., was a small industry back when we started, and had a great run. And I'm still involved in the industry a little bit more on a consultant basis. I do a lot of mentoring in the industry, and I also have a weekly podcast, Rates and Lanes, which I've been doing for about 8 years now with another fellow, Rico Muhammad. It's on every Tuesday at 7 p.m. Eastern Standard Time. And we just talk about issues that truck drivers and truckers and owners of trucking companies have, how to be more profitable. Last week, we did something on health. This week, we're doing something on having a lawyer, Hank Seaton, come in. And Hank's coming in tonight, and he's going to just talk about some stuff that's going on in Washington. So I'm still madly in love with the industry. My passion has never waned. And plus, on the side, I collect old antique trucks. So that's my latest thing.
Awesome.
That's an awesome story. I'm going to get us into the key points of the week, and then Dean will run through the market update, and then we'll bring you back for the discussion at the end, Chuck. Does that sound good?
Sounds great. Thank you.
All right. key trends of the week. I'm a little out of practice since I missed last week. Winter storm Indigo, I still to this day don't know why they started naming these things. Impact most freight markets, rates up, volumes down. We are seeing, I posted about this yesterday, we are seeing seasonally atypical strength in the dry van and refrigerated market, mainly due to this weather. So that's something to consider as the temperature starts to warm up, if those rates start to cool down. The Michigan State trucking ton mile index in November and was down 1% year over year as demand continued to soften. Cash shipment index down 7.2% year over year after dropping 1.6% in December. Those December single family housing starts down 8.6 month over month, but we are seeing a lot of forward looking positive sentiment in home building. Starting to see some positivity in some of the resale as rates come down. Key trend to watch, key stat to watch is that subsidized builder 30-year interest rate for mortgages that dips below 5%. You start to see a lot more activity on the building side. And Dean makes a note here that starts are 16% higher year over year as the housing market continues to be resilient. So with that, I'll turn it over to Dean for our market update. Dean?
Yeah, thanks, Ken. We saw some movement in the market last week as a result of the extreme cold, still going on a little bit in some markets. Load post volumes in dry van up 15%, within 11% of this time last year. Equipment posts were down as fewer carriers were looking for loads as trips took much longer to complete. Load to truck ratio up about 25% to 2.91. In refrigerated is where we saw most of the impact. The cold temperatures sent shippers looking for obviously equipment to stop loads from freezing in transit. Protect from freeze was added to a lot of bills of lading. Load posts are up 25% week over week. There were 12% fewer equipment posts last week as capacity tightened. Load to truck ratio up 41% to just under 5 at 4.92. And in flatbed, load posts were up slightly last week, only up a couple of percentage points. Load to truck ratio relatively flat at 8.37. A couple of markets we looked at. One of the most significant, I think, that was hit in terms of impact on the market was in the Pacific Northwest. Reports of ice accumulations up to 1/2 inch up in Washington State. As in most markets impacted by the cold temps, volumes dropped and rates increased. In Washington, outbound rates were up 3%. Loads moved as opposed to load posted. Loads moved were down 13%. So rates up 3%, loads moved down 13%. Midwest, Missouri market, similar situation. Loads moved were down 14%, spot rates up 2%. Outbound Chicago rates up 7 cents a mile to 2.12 on 17% lower volume of loads moved. So similar theme across most markets. And in refrigerated, looking at some of the USDA data for produce, there was an adequate supply of most trucks last week. However, there was a slight shortage in the Pacific Northwest also. Obviously, the ice accumulation had a significant impact. Pacific Northwest outbound reefer rates jumped 22 cents a mile last week on average. They're averaging $2.49 per mile. That's excluding fuel. And that's identical to this time in 2021. And in Washington State, the volume of loads moved in the refrigerated market was down 6%, while spot rates increased 11%. Significant impact in Nebraska. I think that's probably where we saw most of the market moves in the meat patch. Reefer line haul rates out of Nebraska are up 37 cents a mile. The average outbound rate was $2.98. And in Omaha, volumes were down 31% week over week, rates up 15%. And having a look at our year over year look at spot rates, the dry van line haul market tightened last week slightly. Carriers were looking for higher rates, obviously to compensate for longer trip durations. And line haul rates are up 3 cents a mile last week. As Ken mentioned, a little bit of early season strength there. National average was $1.74 per mile. That's 10 cents a mile lower than this time last year. And in refrigerated, rates, after dropping for 10 cents a mile over the last 2 weeks or the prior 2 weeks, rates were up 6 cents a mile last week to a national average of $2.14. And in flatbed, lastly, flatbed demand is typically soft during the colder months. Last week's cold temps did tighten available capacity slightly. Rates were up a penny per mile, averaging $2 per mile last week. And compared to this time last year, rates are about 12 cents per mile lower. So the long form version of today's market update will be published this evening. Just go to dat.com/market update. Back to you, Ken, for the short-term forecasts.
All right. Thank you, Dean. As I mentioned, the models are going to be freaking out a little bit as seasonality is being bucked here quite a bit. So we start with dry van. The blue line is actuals. It's 7-day weighted moving average, excluding fuel. We go back here to July, to warmer times, sunnier times. The red line is the short-term forecast. The green line is RateCast. That's our flagship model. And you have a couple intermediate forecast models that blend long and short in the middle. And it's pretty much exactly what you would expect given our conversation. So the intermediate models are expecting a return to form. The short-term model has the market a bit overbought at the moment, and expects it to come crashing down to where we were pre-peak. RateCast is really interesting here, and it's I think RateCast is also picking up a little bit more on the cycle and how arguably oversold we are at this point in the cycle. So I think those are interesting data points. When we go to reefer here right now, you're going to see things narrow a bit. RateCast has us ticking back down to certainly not pre-peak levels, but down from where we ended the year. When I say pre-peak, I mean kind of early fall, so that October timeframe, with the short-term model dipping us all the way back down almost to that point. Wrapping up with flatbed, ending on a more consensus note. All four of the models seem to be in general alignment as things start to trend upward a little bit. As things thaw out, if housing continues some of its momentum, we will see this hopefully be strong into the spring. It's hard to see, before we move on to the question of the week, it's hard to see here. Flatbed's in a much longer term malaise as opposed to the cycle that you see with dry van and reefer. So if you zoomed out a little bit, you would see that it's been flat, but it's been largely flat at a bottom for quite a while with flatbed. So that's just something to consider. We're just essentially moving within an error band on the flatbed side. So with that, we will bring the long-term forecast. I was on the road yesterday doing some visits. Was not able to get those around, but we should have those next week for y'all. So back to Dean.
Chuck, question of the week for you to get started. I mean, this is the quietest of the 4 distinct freight seasons in North America. US truckload volumes are down year over year. So let's get started with a quick look at how the Canadian market is looking as we start the year.
It's slow as compared to what we've been through. It's really the norm for what we've grown up with here in the last number of years, other than during the boom cycle that we had post-pandemic or during the pandemic and after it. So one of the things about Canada that people don't realize is that the freight in Canada, this is a big country. It's larger than your country, but the freight for manufacturing is concentrated in 2 provinces, which is Ontario and Quebec. That's where the bulk of manufacturing happens, in those 2 provinces. The other provinces have some shipping that comes out of meat processing and specialty manufacturing. But your volume shippers that are making things like soap, office furniture, shampoos, things like that, some food products that move hundreds and hundreds of loads a day, they are mostly concentrated in Ontario and Quebec because of the proximity to the US market. And Ontario has not done very well at keeping our manufacturing base in this province because of the high cost of operating. Land is expensive, labor is huge, electricity is it's prohibitable. Prohibitive. It's just the cost of it. And that creates, in these times, a shortage of freight, where Quebec is a little bit better off. They have a lower cost. Everything is lower cost there, from the land that the factory is built on to the labor, everything, taxes, everything is a little bit more favorable. So right now, just because of the economic climate, and if you look, companies like Walmart are starting to close stores because they're hurting. So that affects manufacturing, and manufacturing, when it goes slow, that affects trucking. So it's certainly on the outbound much slower than what we have seen in the last 4 years.
Chuck, when I was up there last year, I was up in Nova Scotia and New Brunswick. I was talking to some local carriers that run cross-border, and of course,
right.
Nova Scotia to Boston and New York City seafood markets is a very busy freight lane.
Yeah.
And but I was struck by the paperwork and what's required to get across the border. So it's something that we don't talk about a lot on the show. But can you take us through what's involved in getting a load into the US?
Well, there are several steps. I actually jotted them down because I had to do them in order. So first of all, what happens is you get your information from your shipper, and you get the documents, and you need to send all the commercial documents to the custom broker that is responsible. So your custom broker is the intermediary that works between the shipper, the receiver, and the government to make sure that everything before it hits the border, whoever's responsible for the importation or exportation, it'll work either way. You either buy freight prepaid, or you buy collect FOB, or you buy it the other way. So what happens is when the freight hits the border, it's got to be cleared, and it's got to be ahead of time. So what'll happen is we send our documents to the custom broker, and that's got all the information on it. And we give him a PAPS number, which is every carrier will have these stickers that are printed for that carrier with his name and his SCAC code on it. And the carrier makes the entry or the custom broker makes the entry of that particular shipment, presents it to U.S. Customs, along with things like the harmonized tariff codes of the product, everything. And if it's a simple load of widgets, all the same, it clears very quickly. If you have a complicated load with 50 or 100 SKUs, which will happen with manufactured product, that takes a little bit longer. And we have to have the value and the weight and all of this information to the custom broker. And then what happens is they'll communicate back to us once they've done everything they have to do, and their work is all done. And they communicate back to the carrier saying, okay, you're next. And we then do what's called the ACE manifest, and we send that off to U.S. Customs, including that PAPS number. And we also have we'll have a number that the custom broker has given us, and we give that to U.S. Customs. Then we wait for U.S. Customs to give us the green light and say, now you can send your driver to the border. Now, it could be, it could be 15 minutes and it could be 6 hours. You don't know, which makes it very difficult. And once that driver, once he has that, or he has the green light, then he can go across the border. All that happens then is he presents his personal identification, it'll be a passport or a fast card to U.S. Customs. They have to know, and they see the clearance number, and they basically scan it, and it takes 30 seconds and you're cleared. It's pretty slick. Mm-hmm. And that works very well for everything else except some food products. And I haven't hauled a load of fish before myself, but I would imagine fish may have to go to FDA or Department of Agriculture, which is located right there at the port of entry, and you have to go into a separate office and go in and see them. They look at the paperwork and they go, okay, your lobster can come in. Now, if you have meat, then you have to go to something else called AQI, which is usually located at a separate location, which is near the border, but it could be 5 or 10 miles away. And you have to go into AQI, and you have to get another test for them to go through the paperwork, and then you can go free. And that's basically, there are a lot of steps.
So Chuck, from a brokerage point of view, is that all just priced into the freight rate, or is there is that classed as an accessorial charge that you itemize separately on the bill?
A lot of brokers and a lot of carriers will charge they'll charge a border crossing fee of anywhere from $20 to $100, depending on, because there are so many extra steps now that have to be required to bring a shipment across the border. So there are everybody has their own way of doing things. Sometimes it's included, and sometimes it's an extra cost.
And of course, with cabotage rules, not only you've got to do this to get the load out of Canada, you've also got to have the load back into Canada already sorted out for those carriers that have got to come back, because they can't do a load within the 48 states, correct?
Yeah, that's an interesting one. So as far as your transportation laws go, if you have 48 state authority, you have, as a Canadian, you have the right to pick up a load in Buffalo and take it to California. But your immigration laws prohibit it unless the driver is a holder of a green card, or unless, I believe, if they're Indigenous, then they have a right. The question would be whether that truck, the driver can do it, whether the truck can do it, because the truck is not domiciled in the US. And I remember years ago attending a seminar at the Ontario Trucking Association, and there were two lawyers, a Canadian and a US, and they told us in no uncertain terms that we could interstate, meaning we could pick up a load in Buffalo and deliver to California, no problem, or we could pick up a load in California and deliver to Buffalo. That is not true, and I can share with our listeners that was bad information that almost cost me tens of thousands of dollars, because we had a driver pick up a load in Calgary that was heading to Toronto, but he wanted to take it through the States, and he was a US driver, and we almost got in trouble. They actually stopped the truck and they made him wait for 24 hours. And I spoke to the entry supervisor, who said, I'm letting you go because I understand this was a mistake, but you cannot do it. So what that means also is that we do not have the freedom that the Americans do. If things are slow in one zone, so let's just say you're a carrier, you're based in Buffalo, New York, and things are really slow out of Buffalo, but freight is good in Chicago, and especially going into Florida, and Florida's hot that month, coming back with to the Buffalo area with produce or something. So you could take a load from Buffalo to Chicago, a cheap load that maybe pays 50 cents or $1 a mile even, get yourself in a better place, load up a great load in Chicago, go down to Florida and come back. We don't have that freedom in the US. So if freight is slow here, we have to just kind of wait it out until we can find something to go in that direction. You know, right now I know that our carriers are struggling up here, trying to get into places like California. There's nothing going there. And there's a lot more available equipment to go to California than there are loads. So there's really not much available on the spot board. And what is available, most guys don't want to haul, because it's just so it's just so cheap, and it's just not worth doing.
Yeah, our sister company LoadLink up in Toronto reported that their December volumes are about 18% lower year over year on the spot market.
That doesn't surprise me, because most of this freight going to California and out of Canada, so much of it is not hitting the spot board. And you know, my co-host partner and I, Rico Muhammad, I mean, we were talking throughout the pandemic when the spot rates were crazy, warning people how fickle the spot market is. And we were right, because we're watching people that didn't listen go bankrupt now because they depended on that spot market. It was real good for a little while, but it's dried up. Oh. I've lost your sound there, Dean.
Did we lose Dean? You went on mute by accident.
Sorry. Yeah, I was just wondering about the size of the market in terms of the number of carriers that have been exiting. Is there a mass exodus of carriers, or is it what you would normally?
It's not mass yet, but it's steady. More and more of them, and it's the smaller ones go first. There will be some big ones. There's no two doubts about it. But it's the smaller ones that are going under, because they weren't positioned for. Most of the small ones going under started during or post-pandemic. So they've never known tough times before. They overpaid for equipment. They overpaid for insurance. That's fine. You can pay $30,000 for your insurance per year per truck when you're getting $5 a mile. But when you're getting $1.50 or $2 a mile, you won't last more than a month. And that seems to be what's happening.
Yeah, very familiar pattern with what's going on in here in the US. I noticed that some of the auction data that we're seeing from the big class or the big auction houses is that the number of trucks sold at auction in December surged again. It was the highest since June of 2020 when capacity exited the industry during the pandemic. So we're certainly seeing an exodus of carriers here. I'm not sure that some of that equipment makes it across the border, but I suspect some of the US fleets may have been offloading some equipment also.
Yeah, we have enough of our own equipment that's priced a little bit more fairly than yours because of our Canadian dollar. So we do have Americans coming up here buying used trucks because there's about a 35% difference in dollars.
Talk about the cold weather. I mean, it's cold there now, but how does that impact? At the start of the show, we talked about some of the cold temps and the impact we're seeing on refrigerated freight, particularly to keep freight warm as opposed to keeping it cool in summer. Does that have a bigger impact on the refrigerated market in Canada than we would normally think?
I think it has an impact on all markets just because it takes so much longer to do anything. So your truck that's going to, whether it's going to California or Chicago or Minneapolis, you hit bad weather and, inclement weather, it takes longer. So you're not getting as many miles on that truck, and that has an effect.
Yeah, I was reading some comments from brokers last week about carriers asking for, $2,000 for a 500-mile trip. And of course, the challenge there is that the trip takes twice as long. So even when you look at revenue per truck day, $2,000 for a 500-mile load is still not a winner. You're still behind your revenue per truck day target of, say, $1,200.
Well, I think that's an issue that the industry is facing right across the board with delays. Even the number of hours it takes to make deliveries, or just because of the congestion of traffic. And between that and some of the hours of service laws and everything else, everything takes longer. So you've got an asset, and now with the price of new trucks, a new up here in Canada, a brand new Peterbilt like yours, that's worth close to $300,000 Canadian. Brand new. I don't know what it sells for down the US, but what the heck are you going to haul to warrant a $300,000 investment? Even up here, a plain Jane Freightliner is over $200,000.
Wow.
So it's a lot of money.
Yeah. All right. We're kind of running up on time here, Ken.
Yeah. Good discussion. I'm sitting here just absorbing and taking notes. So Chuck could probably send me a bill for this discussion because I take probably.
I do this to give back, guys.
I'm probably taking a page of notes sitting here. This has been great. You want to move to plugs, Dean?
Yeah. We got Landline Now tomorrow night. I'm on again this week with Jimmy Mack on Radio Nemo, channel 146 on Sirius XM. We've got Rob Kelly coming up on our latest Freightvine podcast. Rob Kelly is from Forum Mobility. He's talking about zero-emission drayage and charging depots for heavy-duty trucks in California. On our show next week, Evan Shelley is from the Truck Parking Club. He's talking about some innovative approaches to truck parking. And then at noon today, our broker team is hosting a Lunch and Learn. It's a quarterly webinar series featuring an in-depth look at our recent product releases. Ben's going to put the link in the show here, and you can register that by clicking on the link a little bit later today. Back to you, Ken, to wrap up the show.
Chuck, I know you said at the beginning of the show, how can folks get in touch with you or the podcast to hear more of your sage wisdom?
Okay, well, thank you. For the podcast, it's available online through Instagram, Facebook. It's on X, it's just called Rates and Lanes. And we do it live it's usually live every Tuesday at 7 p.m. Eastern Standard Time for an hour. If anybody wants to get in touch with me, best way is send me an email with your phone number. It's my pleasure to help anybody in the industry. I just want to give back. This industry has been very good to both my family and to me. And just send me an email, chucksnow280@outlook.com.
Thank you, Chuck.
Awesome. So we're going to wrap up. I want to thank Chuck for joining us. Thank Dean for taking. What time is it out where you are, Dean? It's
1:30 a.m. on
1:30 a.m.
You do better at 1:30 than I do.
Yeah.
God bless you. I was in bed at 8:50 last night. So. Thank everyone for joining us. We will be back next week. I know with the weather transitioning, it might be getting a little bit warmer, but I know that it's going to be inclement in many parts of the country. So I encourage folks who are out and about, especially our truck drivers, to be very safe and very mindful of those changing conditions. So with that, we're going to sign off and we will see you next week. Goodbye, everyone.
Okay.